All right, well, let's get right to our emailed questions. The first one comes from Alice. Yesterday, Alice sold a covered call on Cisco, CSCO, at $53.50. It's an expiration of May 21st, standard May expiration. Now, she first asked, what do I want the stock to move, up or down? I collected $1 per contract. It cost me $138 to close my account, meaning the stock has moved up, so if she buys it back, it's going to run $138. In addition to that, the brokerage cost is $75 if it's assigned, I guess, or called again. She says, I guess I have to let it get called away and pay $75 in May 21. I can't make much because of the commissions. Do you have any suggestions? I don't want to pay $75. Okay, well, first things first, Alice, let's take a look at your position. She has 100 shares of Cisco, cost basis of $52.47, and she sold that May $53.50 call for $1. So with the intrinsic gain from $52.47 up to $53.50 and the $1 premium, the max return she's looking at, if assigned, if the stock is trading above your strike price at $53.50, of course, Alice, you'll be assigned and earn the maximum return. This would result in a $203 profit, or 3.9% off your cost basis. If you have to pay the $75 for the assignment on this position, you're still looking at a profit of $128, or 2.5% off of the investment. That is a reasonable return, in my opinion, for a 14-day trade. Just the price to do business? Yes. What are the first thoughts we probably all are thinking of right now for Alice's questions? Well, number one, we see that it's still a reasonable return on the position, even with the extra cost. Many of you are probably saying, well, that seems really high for assignment. I don't know Alice's situation, if she's international or what brokerage she's using. But yes, $75 on assignment seems pretty expensive. Alice, you might want to consider evaluating other brokers to see if you can get better commissions for rolling and for adjusting with your situation. You probably can. Doesn't help you right now because you can't really transfer the trade over that quickly for the May 21st expiration. Maybe you can, but it's better to start evaluating other brokers, find some cheaper positions there as well. And of course, wait to see if CSCO continues. I didn't see it exactly at the close, but it was right at the money, a price of $53.48, I believe. And this was around $3.45, $3.30, somewhere in that time frame. So it might have gone up a little farther, a little higher, I should say, or it might have pulled back for Alice. Now, as I say to any investor with a covered call or any position, if you're tracking it on PowerOptions using the portfolio tools, you're going to want to go to the position analysis tool. As I'm tracking any position in the portfolio, I can link to position actions from my position, go to position analysis. That will give me a breakdown of my current position, and I can see rollout opportunities evaluated for me. So as we saw, in the next 14 days on May 21st, my apologies, the max return that she can expect, that Alice can expect, is 3.9%. Now we've got to factor in that commission cost, but it's still a 2.5% return. Why is that important? Well, it's important because we see some rollout opportunities shown here to roll to the same month, same expiration, and get a little premium back, but those two rolls would be done at a debit. What do I mean? She collected $1, but she has to pay $1.36 back, and the new premium she rolls up to the 21st 54 strike is $114. So the total adjusted net credit goes down to $78. But if assigned at 54, she'd make 4.5%, a 0.6% gain for rolling up if it's assigned, and gets the maximum return for the covered call position. And then, of course, going to that same month but going higher is only 94 cents, but it would be a 5% return. The options I highlighted down here, going out to the 4th of June weekly series at the 53 strike in the money, the 54 strike at the money, and going out to the 11th of June on the same strike prices, of course, are ones that can be rolled for a pure credit, meaning she pays $136 back now and could go to $187 for another 14 days out in time, to a total 28 days away. But that only increases the max return from 3.9 to 4% for another 14 days. Going to the out of the money, a slight credit of $1.40. Buy back now for $136, get the credit of $1.40, new premium, excuse me, of $1.40, and you keep that sort of $1. And this gives you another 1.1% from the max return. In this case, up to 5% for another 14 days out in time. I don't really like the June 11 ones, to be honest with you, because yes, I'm getting a better premium and a higher credit. We're extending the time to 35 days, so 21 days away from where we would be in this question, where we are right now. But comparing the June 4th, excuse me, to the June 11th, we're only going up by 0.1 or 0.2% for an additional 7 days. I'd be more apt to stay with the 4th of expiration, 4th of June expiration, if I decided to roll these positions. And 1 second here. Donald, I was just getting to this. What is the commission she has to pay to roll the option? That's what I don't know. What is the commission to roll? She didn't tell me that in her email, and I don't think she's here live with us today. So rolling is definitely an option, Donald, excuse me, if those commissions are reasonable in that case. But there are rollout opportunities if you want to stay a little bit more out of the money. If your goal isn't to be assigned, and as Don mentions, and as we mentioned here, what is that cost to roll the position? And if it's lower, this is definitely a consideration. Now, where do we stand? What to do? Well, it's going to be difficult to change your broker mid-trade to try to look for a much better commission cost. We can wait it out, but you want to ask, Alice, yourself, we want to ask, is your goal to hold CSCO long-term? If yes, then you're going to want to consider what is the premium, what is your commission to roll, as we just looked at, to roll to the higher strikes out of the money. And if that's much less than the $75 of taking assignment, that should be your consideration. If this was just for a quick 14-day return, if you were just considering entering this position because you wanted to see a reasonable return for 14 days, we're not there yet. A lot can happen in 14 days. It could still expire worthless, or it could stay up and be assigned. But if this was just for a quick return, I'd say yes, let it be assigned. The $75 off the maximum return. If your stock is above $53.50, Alice, remember, you get assigned at $53.50. You get that $3 profit from your purchase price, and you keep the dollar premium, so you're making $203. If you allow assignment, you pay the $75 commission, you're still making $128, which is a 2.5% return for 14 days. That is the max return for the covered call and might be okay to let happen. Taking assignment is okay. That's still a reasonable return for 14 days. But if you do want to stay in the position longer, your goal is to hold CSCO long-term, then you're going to want to evaluate rolling that option up with those ideas we showed in the last slide and the cost of rolling if you still want to hold on to the stock. Okay, so ask yourself, what were your goals for the CSCO position? Reevaluate that. Are you more bullish long-term and you're just hoping to generate an out-of-the-money covered call premium every 2 weeks or every month to act like a small dividend payment? Or were you hoping to get the max return on the position, which means you'd let it be assigned, be able to move on? Okay. Yeah, you had mentioned, Don, about earnings is 519. I don't know if you were talking about pins when we were looking at that for the long one. No, it wasn't that one. Okay. We were talking about those, or if it was related to Alice's question. Oh, yeah, it was. Okay. So it's another thing to consider. You're absolutely right before 521 that there's earnings. And if she leaves it open through earnings, she can get assigned, and that's great. The dividend was on 4/5. It looks like that was the last ex-dividend date down there for things. But that is, thank you. That is something I should have considered. I didn't think about that. You're absolutely right, Don. I should have asked Alice about that or mentioned that during Alice's discussion that earnings are coming up. I'll try to add that into her discussion. Great point. But hey, if it does go up the direction she wants and she gets assigned, we already talked about how that's still a good play. And if it falls because earnings are poor, well, maybe her call expires. She doesn't have to pay the $75. So you're right. Maybe it's worth it for her to hold it through. She'd still make the good 2.5% return in 14 days if it goes up. And if it pulls down, hopefully not too much, not a 15 or 20% decline, just a 4 or 5% pullback, her call will expire. She wouldn't have to pay $75. Now, this leads us to where we're going to see some comments and questions, and that's perfectly fine. But this leads us to Pierre. Pierre sent me an email, says, what is the best strategy to collect monthly income if you want to earn between 2 and 3% monthly? Even with the commissions we just saw for Alice, if she gets assigned, it's still a 2.5% return for 14 days. So the monthly and weekly covered calls, or even potentially the naked put trades, would be a good approach, a very common approach, looking to make 2 to 3% monthly. Okay? We show these things called the picks of the day, both for covered calls and naked puts, and both weekly and monthly picks of the day, Pierre. And what this is, these are the results of Ernie's extensive testing. What he set out to do, sort of challenged 5, 6 years ago, he sort of challenged by a customer on the phone. He says, well, Ernie, if you've been trading since the 80s and you've had this site since 1997, yes, you've got these default screens in your searches. For covered calls, it's at the money initial values, in the money, and there's an out of the money search as well, because you can trade covered calls 3 different ways. Whether you want to be more conservative and look for a regular, consistent profit, you'd be in the money. If you want to earn the highest time value, you're going at the money. Or if maybe you're looking, as we just mentioned, for Alice, you were maybe thinking you wanted to hold a stock long term, try to collect a dividend like premium but not be assigned, then you'd be using out of the money. But the customer essentially challenged Ernie and said, what is the best criteria to use to have the best success rate over time with covered calls or naked puts? And that's a tough question, because what do we know about the markets? Well, the markets are ever changing. So yes, what did work best at one period might not work best the next period. But what Ernie set out to do was find a set of criteria not involved with rolling or managing, just looking for positions that had a good return rate and a good probability of being assigned, taking the profit, or in the case of the naked put, expiring worthless, and then moving on. Not worry about rolling. If it hits a sudden stop, or a certain stop, I should say, if the stock falls 7% or 10%, just close the position and move on. Now, these are not direct recommendations or suggestions. They're ideas based on Ernie's answer to this customer of what are the most successful criteria you've seen for covered calls or naked puts, weekly or monthly, over a 12-month period. And essentially, this is what the picks of the day shows you. But as we mentioned before, these are giving you ideas. What you want to do is maybe use the search tool under covered calls. You can see the exact criteria for these searches and adjust them based on your risk tolerance and your personal goals. But we did have a YouTube comment on this a month ago, not almost a month ago, but after we posted a webinar in April discussing the weekly picks of the day for naked puts, Sean had asked about the picks of the day returns. And so I did a 1 year to date back test run with our tools for the covered call weekly picks of the day from April 13th, 2020 to April 16th, essentially when Sean asked his question. And the weekly covered calls had a rough end. But in the first 11 months, it was at a 26.7% profit with about an 80% success rate 11 months in. There's about your 2 to 3% return per month, but that was using the weekly options. But there was a rough end of March and early April, and ending on that date, 4/16/2021, it had a 13% profit, shy of the 2 to 3% you were looking, but still a 78% success rate. The full year of 2019, roughly from December 30th, 2018 to December 28th, I think it was, of 2019, the weekly covered calls following the suggestions that Ernie mentioned with the stops that are there and that right up under the covered calls was a 41.6% return, 82% success rate with 102 trades over 2019. The monthly, for that year-to-date period of 4/13/2020 to 4/16, and again, that was just selected because that's when Sean had asked the question. I just ran that test and it finished 10 minutes before the webinar. But using Ernie's stop suggestions there with the monthly picks of the day for covered calls, that showed a 53.2% return. What does that mean? Well, you can read about it on Ernie's testing there on the site. Essentially start with $100,000, allocate 50% into the top 2 trades or 30% into the top 3 trades, and what is the end result at the end? And this one here was $153,200, a 78 success rate with 28 wins and 8 losses. So that's making the 2 to 3% return. And that was that year to date. I didn't get a chance to run the 2019 results just to see what they were. Big warning and disclaimer. Ernie tested these over his initial time period of 2015 to 2016. I've gone back for customers during the webinars to look at the tested results as well and to run different segments. So we did for Sean for the weekly covered calls and the monthly covered calls that we just did for Pierre. Of course, options trading involve risk. You saw that decline that I had just posted for the weekly covered calls for the end of March this year going into April. Picks of the day are not recommendations or direct trading suggestions. Research and analysis is key. You want to make sure you use the tools on Power Options to further research and analyze those positions. Make sure they match your trading goals and your risk tolerance. But at the same time, you can use the search tool. You'll see the full criteria listed for the weekly or monthly picks of the day, covered calls or naked puts, and you can adjust that criteria to meet what kind of stocks you want. And so, yes, I think the covered calls and potentially the naked puts approaches, Pierre, are generally ones that investors use on a regular basis to try to see that 2 to 3%, whether you're using monthly, whether you're using weekly, if that's your target goal. Can other strategies earn more? Yes. I mean, I can see higher returns from in different years using the bull put credit spreads or different strategies. But although you can lose on covered calls, and you saw there was 78% success rate, you lost on 22% of those that went against you in those cases, or they were closed because the suggested stop was hit. And the goal is not to roll those, just give you ideas with less management. But with doing spread trades, even though I might see a higher percentage return over the same time period, at one point or another, I can guarantee you that portion of a leverage spread or maybe even a long call portfolio is going to be down 40, maybe 50% for sudden movements in the market. That's just the way they work. Covered calls, you might see a drawdown of maybe 10%, maybe 15%. But leverage works both ways. So when you're doing credit spreads, even with a high probability, when you're doing calendar spreads, you expect to see a higher drawdown, but at the end over time, you might see a higher expected return as well.